Well, the era of so-called cheap credit is over. That's the major call from our economists this morning, who say that Australian mortgage holders are in for years of pain, warning that interest rates are set to remain high for a very long time. Experts say economic shocks are now the new normal, which will in turn keep inflation high. For more, we're joined now by Brian Parker, who is the chief economist at the Australian Retirement Trust. Good morning to you, Brian. Okay, we say cheap credit, but really that is a vexed term because already many people feel that their current mortgage is pushing them to the absolute limit, right? But is this the new normal? Should we just expect that interest rates of this high are going to stay this way?
No, I wouldn't think so. If anything, there is always a cycle. And yes, we saw interest rates really surge after the end of the COVID pandemic. Then once the Reserve Bank and other central banks started to see inflation fall, they were able to reduce interest rates. Now the world's become more complicated. We're still going into the war in Iran. We still had inflation above where the Reserve Bank wanted it to be. Now we've got the impact of the war and on petrol prices and the like. And it just means that the problem the central bank has is that on the one hand, they're worried about the potential impact on growth, but we still have inflation that is above target. So I think there's still some scope for interest rates to potentially rise a little bit further. But longer term, though, I think it's important to keep a bit of perspective. I think interest rates right now are probably higher than where they would average over the longer term. Just roughly speaking, if you think about where the cash rate might average over time, we think it's somewhere between 3 and 3.5. Add about 2% or maybe 2.5% on top of that for your mortgage rate. That's a kind of realistic assessment of where interest rates are going to average.
That's a really interesting point there, because in the whole, it can seem as if Australians are pretty pessimistic at the moment. The Melbourne Institute of Consumer Confidence, that confidence level is down 2.9%.
Yeah.
But you're saying take a step back. So for people that are at home this morning, you're saying just wait and see and hold on if you can?
Yeah, I think so. And what's interesting is the pain that consumers are experiencing is not evenly distributed. If you're renting or trying to find a rental property, if you took out a mortgage relatively recently, in other words, you haven't seen the benefit of very strong house prices, for example, and you've now seen interest rates go up, there is pressure there. But there's other sectors of the economy and certainly other sections of the household sector that are actually perhaps doing quite okay. If you happen to have a mortgage paid off, if you are, for example, approaching or in retirement, you're probably sitting on a superannuation balance which is a bit bigger than you might have thought. And so consequently, I think the fact that that pain has been very unevenly distributed is a real problem.
It really depends on where you are, doesn't it?
Very much
Okay,
so.
Brian Parker, economist, thank you so much.
You're welcome.